thing about doing these presentations live is I can just dive into the very same charts that I'm trading off of, and the very same charts that I'm in right now. You can see my P&L as we're going. You can see where I'm taking heat, where things are going well, where things are not going well. There's nowhere to hide here. I like to say there's nowhere to hide when you're trading out loud, and I definitely like a fishbowl atmosphere where it's just really as much transparency as I can offer you, because that's the only way really that you're going to learn from what I'm doing right, what I may be doing not so right, etc. So today's conversation is actually coming on the heels of a pretty interesting time right now, and that is the fact that the directional bias, and I'm going to get into defining that here in a moment, but the directional bias and the themes that I have been working since basically the beginning of the year are starting to show the very first signs of maybe a correction, maybe not necessarily a reversal, but just a shift in sentiment, and therefore a shift in momentum. And let me define what I mean by that, because it's pretty important. I'm just not throwing these words out there. Sentiment is what people are thinking. When they all think, when I say they, I mean the market at large. When the market at large is thinking a particular way, it then will create some momentum, and if there's enough sustained momentum, enough participation, at some point you'll end up with a trend. So trend basically is sentiment plus momentum, and it yields these up or down trends. When I refer to directional bias, I am quite simply referring to whether or not there is a trend on the daily time frame. Really that simple. And I see here that there's a question about the pound kiwi. I'll be more than happy to address that. So here is the pound kiwi. And let's tackle the first question, which is, what do I think of it? Well, Bob, thanks for the question. The answer starts with understanding, is there directional bias? And again, all that means is there a trend on the daily time frame? Just that simple. Why the daily, some of you might ask. It doesn't mean that I'm fixated on trading the daily. It simply means that before I start to dive into a pair and do analysis, it would make sense to step back and ask myself, overall, who's in control? If this is a car driving down the highway, is it heading north or is it heading south? Or is it just stalled on the side of the road or at a rest stop, whatever? Okay? Is it moving in a general direction? Now, I guess general direction can be kind of subjective if you think about it, because some people might look at the general direction and focus in on maybe a handful of sessions. Okay? Some people might look at a general direction and look at a high to low. And I probably should use something other than yellow so it's more visible here. Some people might look at a recent trend. As I mentioned, some people might look at the high to low. And again, some people might look at just a handful of candles from the last few trading sessions. I'm not necessarily saying that one is righter than another or that any are wrong. It's just really a matter of perspective. On a daily time frame, psychologically speaking, it's relevant to look back 1 year. 52-week highs and lows are pertinent here. People will look at what the trend has been. In fact, when it comes to a daily time frame, some people might look back and say, hey, February of 2012, where were we? Where are we compared to looking back 1 year? Now, I realize that the horizontal axis here, the calendar axis, doesn't necessarily lend itself to a perfect 1 year look back. But if I look back to the 15th of February, which puts us right about here, not perfectly, but right about here, I'm basically looking at where we are in relation to where we were just a year ago. That might be one way the market's perceiving where we are right now. Is there any way that anyone's going to look at a 1 year look back and say that we are better off, higher, stronger than we were a year ago? That's one way of looking at psychology. It's a very generic way. It's not necessarily effective for trading, but it is one way of saying, yeah, we are lower. Are we at 1 year lows? Absolutely. Okay, so the market might say, hey, we took out a 52-week low. We took out the 2012 lows. Heck, we even took out the 2011 lows. So these are at multi-year lows. These are things that we can only ascertain in terms of this type of information. We can only ascertain it in terms of looking at a daily time frame. We're not really going to see this on a 240, certainly not on a 60 or a 30 or a 50-minute time frame. So we're talking about a larger, longer psychology. Again, not because we're going to necessarily trade it, but because the daily time frame is probably the one that is viewed more than any other time frame. And the close of the market, I know that's kind of a misnomer in Forex, but the daily close does have a certain psychology that, say, a 5-minute close or a 1-hour close does not have. So there is some relevance, lots of relevance actually, to looking at a daily time frame and saying, okay, what's the psychology on it? The daily, therefore, is the dominant psychology. If I'm going to determine whether or not in this case, the pound kiwi is in a downtrend, I'm not going to do it with a 240 or a 60 or a 30. I'm going to do it with the daily. I'm not going to do it with a weekly or monthly either. Longer isn't better here in terms of the time frame. The daily time frame, again, is probably the one that is viewed by the most eyes around the world. So then I'm going to move on to how I determine what the trend is. And I try to be a little bit more objective about it by having some guidelines. So the first guideline is I want to have a 1-year look back. Now I mentioned before we can't exactly slide perfectly 1 year into this view. So I can just take my horizontal tool and basically slide it to the 21st or 22nd. Today's the 21st, so we might as well just put that in there. Slide it to the 21st of 2012, February. So everything to the right of this black line here represents 1 year. So I can see the highs we've made, I can see the lows that we're making now, and I can see or ask myself, what's the dominant color that seems to be visible on this look back? Well, it's funny because when you look at early 2012, a lot of bullishness. Mid to, say, summer, actually early to mid-year, we saw some bearishness. We spent a lot of time chopping around going into the end of the year. And I'd say right now, the dominant psychology is down. Now, if I want to zoom in to what a lot of traders are looking at, I could most definitely just say, yes, within the context of a downtrend, we're getting some congestion. There's a big difference between saying this market is congesting, which I would believe is incorrect, versus saying that within the context of a downtrend, we're congesting. True congestion is more akin to what we saw in this area. Okay, that's truer congestion. This is a market that is slopping around sideways. It's an established slop, if you will. It's an established chop. And the market is moving within a trading range. When I look at what's happening right now, where are the clues? Well, one, I have visually my 34 EMA wave, which is sloping maybe not really well or cleanly, but it is sloping downward. When prices do try to rally, they seem to fail either before or inside the 34 EMA wave. Add to that, I have consistent red grab candles. So we continue to close below the 34 EMA low, and the candles are red, reflecting the bearish sentiment and momentum. It's that bearish sentiment and momentum, by the way, that culminated into the organization of this downtrend. So we have a downtrend, yes, but within the context of the downtrend, we are stalling, or at least for a little while, congesting. I'm not going to say this is the dominant psychology because the baggage that this pound yen is carrying is still very much one of a lingering, not now, but a lingering Kiwi strength and an overall pound sterling weakness. Now, I say lingering because not but a few days ago, we had, so I say recent because not but a few days ago, we had RBNZ Governor Graham Wheeler, come out and basically sweep the legs out from under the Kiwi. It was the flavor of the month, very much for February, and it was gaining against many currencies. In fact, if you pit the Kiwi against the pound or the yen, you could see how much it had been pressuring those weaker currencies. And those are great places to be positioned. Kiwi yen or the pound Kiwi, great places where you could take advantage of Kiwi strength and simultaneously take advantage of, in this case, the yen weakness or the pound weakness. So what Wheeler did, and this pertains to both the Kiwi yen and the pound Kiwi that we were looking at before, what Wheeler did was basically make the Kiwi bulls question just how much more Kiwi strength they could expect. He opened the door, one door that we really didn't expect to be opened, not even this year perhaps, to potential intervention. Now, what's so funny about what Wheeler said and who he said it to, and subsequently the way the market reacted to it, what's so funny to me is when you step back, and it's interesting because I was discussing this in the morning chat that I hold every day, and one of the chatters in the room said, hey, isn't it funny that he was talking to a bunch of manufacturers and exporters? In other words, he kind of organized his speech to his audience. He wrote his speech, delivered his speech to a very particular audience, an audience that wanted to hear that he would do as much as he could to keep the Kiwi exchange rate at a reasonable level because it's gotten so darn strong, it's hurting exporters. It seems the market ignored the fact that that speech was very catered to a particular audience. And the market also seems to have ignored that within the context of that speech, yes, he did say that the exchange rate is overvalued. And yes, he did say that they would be ready to act if necessary. And by the way, what central bank doesn't say that? Doesn't every central bank say that, quite frankly? Of course they do. No central bank is going to say, we're going to stand idly by while these forces negatively affect our currency. Every central bank says they're standing by. So what I found his speech to be is one catered to the audience that he was speaking to and a vague, obvious central bank generalities. What I see the market completely gleaned over was the fact that he was very particular about using examples of the RBA and the 1 3/4 point cuts they have executed since November of 2011 and said, see, they tried to weaken the Aussie to no avail. And he's been very frank that the RBNZ doesn't have anywhere near the kind of powder to be able to do even what the RBA did or even the BOJ. They can't do that. They can't compete at that scale. And that any kind of weakness would really only be a temporary reprieve. He was very frank about that. But the market, and let's face it, we could parse through the whole speech he made, but quite frankly, what the market glommed onto was all the potential for intervention, which I don't think is a reality. Doesn't matter what I think, though. What the market thinks is that perhaps the Kiwi strength is overdone at this level, and then Wheeler just went ahead and put a punctuation mark on that. Because realize that this market started to congest within the context of the downtrend before Wheeler ever even opened his mouth. Okay, you can see that we've been congesting. We started really just after Valentine's Day. So we've been congesting for a little bit, not a long time, but before he stepped out and put basically the kibosh on lower lows on this pound Kiwi and higher highs on the New Zealand dollar. That's all fundamental stuff, right? But I can see how the fundamentals are playing out within the context of this market. So back to directional bias. And also, I want you guys to realize that I don't ignore fundamentals. Okay, the themes that I look for in terms of what's being discounted into price, I do try to get a grip on those fundamental themes. Make sure I respect the data that's coming out. And then I look to see the way in which the market is actually reacting. So if I was in a bubble, got a text of the speech that he gave to the Manufacturers and Exporters Association there, and I read it, being a Kiwi bull, I probably, as human nature would have it, I'd probably hang on to all the reasons why I feel the Kiwi should continue strengthening. Yet, the truth of the matter is, it doesn't matter what I think. It only matters how the market digests it, which is what I find very interesting about fundamentals. They are open to interpretation. Not only are they open to interpretation, we have to realize that certain aspects of fundamentals, being repetitive in nature, might already be discounted into the market. We might already have said, yeah, we know that. We've already reacted accordingly. So don't ever think that just because you've discovered a particular fundamental that this is like you planting a flag on the moon. You likely were not the first one there. You likely were not the 101st one there. Okay? We're going to remember our place on the food chain, and it's not to be the first one there. That is not my job. My job is to look at those, this is a great analogy. It's like saying, look, it's a huge market for sure. But if anybody's doing anything in Forex, it's like an elephant leaving tracks in the sand. Yeah, eventually the tide might wash it away, but it's going to take a little time. And there's no way that elephant's tromping across the beach and not leaving some footprints in the sand. It's my job to be pretty quick, find out if the footprints are there before the tide washes them away. So there's two analogies here. One, yes, there's no way an elephant's not going to leave footprints in the sand. But two, you've got to stay on top of these things, because if you are lazy about it, eventually the tide will wash them away and you won't be able to see the evidence. You'll be too late. Okay? Two analogies all wrapped up in one. An elephant and the beach. How awesome is that? So directional bias here for me means what? Would I expect more weakness out of the pound Kiwi? I actually do. Right now it might seem impossible that the pound could weaken anymore and that the Kiwi could strengthen. But ultimately, I do think that if this were a fight and the pound is in one corner and the Kiwi's in the other, the bell rings and they're getting ready to fight, I still think the Kiwi is going to stomp the you-know-what out of the pound. My money's on the Kiwi. Therefore, I am going to expect lower lows. All right? So I have a comment here from Bob who mentions the New Zealand has a housing bubble. Prices are rising. The dollar has been strong. Yes, I agree. It's definitely been a safe haven in many ways, as has been the Aussie. If Wheeler raises rates, which I don't think he's going to do, the dollar gets stronger. There's no way he could raise rates. The rate is already too high. If he keeps rates the way they are, I agree with you. Housing is going to continue to get higher. How do you shape your fundamental view when most traders don't know the internal situation of a particular country? That's a whole other conversation getting into, I don't do fundamental research, but I do what I call headline surfing. I do want to see not the invisible forces that are moving the market. I want to see what the visible forces are. In other words, what are the headlines that traders are keying in on? What are the persistent themes that appear day after day, session after session in the market? And how is the market reacting when those are the dominant themes? The bottom line is I don't have to be an expert in the New Zealand dollar. All I need to do is surf headlines to see what it is that traders are reading and reacting to. Okay, most are not going to go do their own fundamental research. The ones that are typically the ones writing the articles and the analysis, which ultimately become the headlines that we see. From a central bank perspective, I don't believe Wheeler is even deluding himself into thinking that the RBNZ has the kind of power to overpower any Kiwi buying. People are going to continue to buy the Kiwi. Even if he lowers rates, they're going to continue to buy the Kiwi. So he really can't do anything but perhaps try to talk the Kiwi down by opening the door to saying, hey, I might. At the same time, if his objective was to maybe slow the inflows, did he do a good job? Absolutely. So, even the BOJ, who pushes the sell trillion yen button, gets run over like a dump truck. The market just dump trucks. Even when we get those spikes in the yen where the BOJ intervenes, we get 2, maybe 3 sessions of some yen selling, right? When the yen gets too strong, BOJ sells trillions of yen, and the market just goes, ha, yes, you squeezed some shorts, but we're going right back in and shorts meaning in the dollar yen or whatnot, but yes, you squeezed the temporary psychology, yeah, ha, you got one on us temporarily, but we're going to come right back at you and start buying that yen again. So I probably should have used the word squeeze. I'm thinking of some of the pairs. So like a dollar yen. So some dollar yen shorts would get squeezed temporarily, but then they'll come right back at it and drive that pair lower. Same with, say, the euro yen. Okay? So I don't think he was very clear in the speech about that. Yet, here's the point. The market doesn't care. The market doesn't care one bit. All he did is maybe give people just a little bit to be nervous about when it comes to possibly continuing to buy the New Zealand dollar at the rate that they are buying it. He just made them hesitate a little bit. He slowed it down. That's the same type of saber rattling that the BOJ does before they intervene. They don't want to intervene. They saber rattle. They hope they're slowing the yen buying down. When ultimately it doesn't work, which it never does, the saber rattling, they go ahead and have to intervene. And all they're doing is just scaring some of the money out of the market because they're changing the paradigm of the currency. They're making those yen bulls, or in this case, with what Wheeler did in the Kiwi bulls, are making them question whether or not they can expect, in this case, lower lows out of the pound yen or higher highs out of the Kiwi yen. But the bottom line is, I'm following the overall directional bias. Again, the trend is your friend. So let me get back to a little bit of some technical discussion here. Whenever we are looking at selecting pairs to trade, what might be good pairs that could offer us opportunity, we want to stick with pairs that have an overall directional bias, an overall psychology that's dominating it. Regardless of what some short-term congestion or consolidation might be doing, we want to step back and look at that 1 year, look at the angle of the wave, look at the grab candles, what color are they consistently printing, and say to ourselves, yeah, on the Kiwi yen, most certainly, this is a strength play for the Kiwi, a weakness play for the yen, and the bulls are firmly in charge of this market. Doesn't mean it can't reverse, but anything that would lead us to believe that we want to get into this market short would be counter trend. I don't want to be counter trend. I don't want to swim upstream. It's exhausting. I wrote an article at my blog at roggyhorner.com about swimming upstream. And it's not affiliated with IBFX or TradeStation anyway. It's my personal private blog. But I was writing about swimming upstream and how salmon have taught us pretty much everything we need to know about swimming upstream. That you're likely going to die on the way, get eaten by a bear, and if you do make it all the way there, you're going to die. Very positive talk, isn't it? But what I want you to see is it's exhausting. My other favorite analogy is, can you run up a down escalator? You might be able to for a step or two, but at some point, the escalator is going to win. Okay? So, do I want to fight the up escalator here on the Kiwi yen? Not even a little. What I'd rather focus on is the fact that the bulls are in charge, the Kiwi is the strength play here, the yen is the weakness play here, and that would lead me to do a couple things. One, once I say the market has directional bias, I want to identify if it's up or down easily. This is very much an uptrend. In fact, let's go ahead to my profile of the Kiwi yen. Okay, so one, I have an uptrend here, for sure. Two, I'd rather position myself long. No question about it. I might have done so aggressively for one of my entries. I've done so more conservatively for the other, but I want to position myself long with the overall trend with the overall directional bias. Any short position is counter trend and should therefore be limited to, and again, let me say this again, we have an uptrend here. The easiest filter you're ever going to find is going to be the daily time frame. I'm just talking about a filter right now, not even a tradable setup. Sometimes finding the right time frame to trade and the right direction to trade it in is the biggest challenge. So if I have an uptrend here, which I most definitely do, I want to say that I'll trend follow on any of the time frames. I'll take a buy on any time frame if it sets up. I will only go counter trend on the short-term time frames. I will stay nimble. So again, imagine that escalator moving up. Can you possibly make it for 2, 3, 4, 5 steps? Maybe. Imagine those 2, 3, 4, 5 steps as the 5, the 15, and the 30-minute time frame. Imagine swimming upstream just for a little bit, not for the long haul. A little bit, again, means 5, 15, 30. The long haul means more 1 hour, 4 hour daily. So if I have an uptrend, short is counter trend. Again, if I have an uptrend on the daily, bullish directional bias, then counter trend is a short. And I really don't want to commit to that for the longer term. Will there be shorting opportunities? Sure. There have been with just the last 2 sessions moving lower. But I don't want to pick, the only way I could have taken advantage of that on the daily was to pick a top. That's a risky way to trade. That's a revenge-oriented way to trade. Why don't you think about something for a second? If you're long the Kiwi yen, are you consuming yourself with thoughts of where you're going to be short? Or are you just pretty much hoping that this Kiwi continues to climb and batter the yen, and you're pretty much looking at the 79.50 to 80 area and hoping for higher highs? And the only reason you'd be looking at potential resistance levels would be as hurdles and potential profit targets. Are you consumed with short setups if you were already long the Kiwi yen? No way. So the only people who are short in this market are most obviously people who are not already long, which makes counter trend trading on a longer term time frame really revenge trading. Okay? Now, can you short intraday? That makes more sense. I'm not saying you can't short an uptrend. You just won't do it on a longer term time frame. Again, you're not going to want to swim upstream for very long. You can't. It'll exhaust you. Were there opportunities over the past 2 days to short the 30-minute chart? Absolutely. I, one, recognize that I'm going counter trend. Therefore, I'm going to be nimble about it. Again, short-term time frames. And then I can go about executing my swing shorts within the area between the 20-period simple and the 34 EMA on the low. So if I wanted to trade counter trend, which I typically don't, but if I wanted to, the 30 minutes said, hey, I can take advantage of the weakness for you. You can stay nimble with this short-term time frame. You don't have to commit to me for the long term. This is a 30-minute slice of psychology. And as long as there's intraday weakness, I'll guide you lower. The 15 will say the same thing. The 5 will say the same thing. Sometimes we'll make exceptions for the 1 hour, but for the most part, I want to stick to counter trend trades on the 5, 15, 30. I said that though daily can oftentimes be the easiest filter. And by that I mean, if we don't have a psychology on the daily time frame, case in point, the Aussie loonie, do I want to spend a lot of time trying to set up this pair? I don't. I don't know who's in charge here. I don't know who's behind the wheel. There's no clear indication that the bears or the bulls are driving the movement in this pair. If I don't know what the dominant psychology is, it's much more difficult to trust what will happen at decision levels, which is just my way of saying what will happen at support or resistance levels. So we want to avoid pairs that don't have a trending daily. Again, it's not because we're going to necessarily trade the daily, but it's because we'd like to focus on where there is a clear psychology. That's our edge, by the way. You bring up a good question, Mike. What drives a pair? As far as the factors, in my opinion, I chart hack. What do I mean by that? I look at 3 avenues of analysis. I think there are 3 relevant avenues. One is fundamentals. You really have to be a hybrid trader. Anyone who thinks they're just going to hang their hat on one type of analysis, and by types I mean one type is fundamental, one type is technical, and one type is price. Okay? Technicals and price are not the same thing. Technicals are actually a reflection, usually some sort of arithmetic calculation of price. Price has its own psychology by way of support, resistance, major and minor psychological levels, the momentum of order flow, the momentum of order executions. Technicals are your moving averages, of which my wave is one of them. Technicals are your are your Fibonacci's, your Elliott waves, your indicators, all that kind of stuff. Chart patterns. Chart patterns are probably borderline into price action, but you're really looking at three different ways. What drives a price of a pair typically most commonly are fundamentals. Okay? But that doesn't mean that's how we trade the market. Just because fundamentals move a market doesn't mean we can measure a market accurately with them. It's really actually very difficult to measure a market with fundamentals. Smart technical traders, smart price action based traders marry the two. Actually, really smart traders marry the three. That's what I like to think a chart hacker is. They understand price and the value of what it reflects about the psychology of the market. Same with technicals and same with fundamentals. They mix all three. That's the ultimate hybrid trader. So if you are looking at all three aspects, you're definitely giving yourself an edge. I think another part of understanding what's driving a pair is understanding the individual currency story. Like, for example, I don't like the Aussie loonie right now. I think the Aussie story it's a difficult one to gauge because on one hand, you have an RBA that isn't all that dovish right now, yet you have a market that's overwhelmingly discounting anywhere from a quarter-point rate cut starting in March to an entire point throughout 2013. Yet this Aussie isn't weakening at all because it's a safe haven currency. So it's a AAA credit rating currency, high yielding currency for that matter. But even though we have what would expectedly be later on this year a dovish RBA, Aussie doesn't care. It's the honey badger right now. It just doesn't care. So I don't think we have a clear story about what's happening in the Aussie. I think the loonie is a more difficult story because you have a currency that's completely disconnected from its commodity currency personality. It's completely disconnected from crude oil. Carney is leaving in July, which places a big question mark on the leadership and whether or not the BOC stays as hawkish as it kind of has been. There's probably nearly 100% agreement that amongst the G7 countries, the BOC is going to be the first to hike rates. But they've been toying with the when of it for the better part of a year and a half. They toyed their way through 2012 about, yep, we're going to raise rates, yep, we're going to raise rates. Not yet, not ever, it seems, right? But still people expect them to be the first to ultimately raise rates. When that will happen, nobody knows, and so they stopped discounting strength in the loonie based upon this expectation of a rate hike. In the meanwhile, the loonie does seem to be right now reacting because, and how do I know this? How do I know it's reacting to negative fundamentals and not, or I should say bearish fundamentals and not bullish ones? The price action. The loonie's had a hard time getting out of its own way because it seems traders are viewing the loonie through the eyes of all the potential issues that are coming up in the U.S. Is the Fed going to end QE mid-year or end of year? How quickly are they going to wrap that up? We don't know. So that casts a shadow over the I guess, symbiotic relationship in many ways Canada has with the U.S. I don't even know if I call it symbiotic. Obviously the Canadian economy is highly reliant on these crude oil exports, of which the U.S. is the number one consumer, I believe. I don't think China's overtaken us there. So they're very reliant on our economy doing well. Well, sequestration puts a question mark. The Fed's put a question mark. There's a lot of, even though the Dow continues to pressure 14,000, there's a lot of questions about whether or not the equities market can continue to rally. Those types of questions about whether or not the risk-on environment can sustain here in the U.S. Whatever the reasoning is, the loonie is just focused on bearish factors because it's not getting out of its own way. So I don't have a clear theme there. In fact, we don't even have a really clear direction for the Canadian dollar itself. So I can't say there's a good, clear directional bias on this Aussie loonie, because on one hand I have a very fuzzy Aussie picture, I have a very fuzzy loonie picture. But that's all fundamental discussion. Even if I didn't know any of that, when I look at the daily chart of the Aussie loonie, is this in a trend? Not even close. So do I have a dominant psychology here? I don't. It's the easiest filter to apply here by saying, you know what? There's no psychology. I'll move on. I mean, the Euro-US is a very strong recent example of what happens when we lose the dominant psychology. And we lost it just yesterday. So what happened here? We had kind of a shaky uptrend, but an uptrend nonetheless, that arguably started middle of last year, extended into the latter part of this year as traders were looking past the fiscal cliff, and extended into the beginning of this year. And now what's happening is that, okay, now I want you to think about this for a moment. Let's marry fundamentals, technicals, and price action. Do I have an uptrend any longer? Well, there's a lot of recession worries fundamentally that have kind of recirculated. News is often like a Ferris wheel. We focus on something like the horse going by, and then it turns the corner, goes to the back of the Ferris wheel, we can't see it anymore, and then it comes right back. Well, that recession fear is like the Ferris wheel, not Ferris wheel, merry-go-round. You know, news is like a merry-go-round, and it's come right back. That merry-go-round recession concern is come right back around. So fundamentally, the market, obviously, with the most recent 2 days of trading, has pushed lower because the fundamentals are focusing on the negativity again. By the way, if you go back 2 months ago, the market couldn't get enough of the optimism story. Draghi had to talk the euro down because it was climbing too quickly. Bond auctions were going off well. We're having all this optimism as far as the euro recovery. And then all of a sudden, now we're concerned about a recession. News really sometimes is just that cyclical and, dare I even say, ridiculous in nature. We had a trio of very weak GDPs coming out of Europe. That's a fact. But the market more or less shrugged it off and continued to look optimistically. I think perhaps the buildup of somewhat weak data is starting to chip away at that optimism, and then Mario Draghi came in and just tried to talk the euro down while talking the eurozone up. That was a pretty neat trick. He can't do it for very long, but that was a neat trick he pulled off, and that seemed to have started the transition that we're seeing here. So fundamentally, I know the picture is changing. Technically, I know the picture is also changing. We are going from kind of a shaky, ugly uptrend, but an uptrend nonetheless, now to likely what could be a distribution like chop. Are the bulls in control? No. Can I base any kind of position in the euro on the assumption that there's optimism and that the bulls will step in at support after pullbacks and buy again? I can't. We don't have that type of predictability in a non-trending market. So just as I expect support to be bought into within the context of an uptrend, and the way I expect resistance to be sold into in the context of a downtrend, when we have no trend, which is what I now deem this market to be in, it's a non-trending market, not a downtrend yet, mind you, but a non-trending market, there's confusion. Why? Well, the bearishness is a relatively new psychology that's taken hold of this market. I've gone from trading above the wave with blue and green candles to now red. That shows a shift in the sentiment and the momentum. I'm not going to call this a downtrend because just like an uptrend may have taken a little while to build and establish that psychology within the market, get a real hold of the market, the downtrend doesn't happen in 2 days. I don't break an uptrend as ugly as it was that started last July with 2 down days. That triggered. I mean, that's just not the way it happens. Is there more near-term bearishness? Yes. There might be, though, because we've been in an uptrend since last summer, some lingering bullishness. Okay, because take a look at the last year of price action. For the most part, since July, we've been moving up, but before that, we were moving down. Are we basically almost break even on the year? Yeah, we kind of are. If we were to look back to February of last year, we're kind of in the same spot, aren't we? So recently, we've been in an uptrend. There might be some lingering bullishness, but technically speaking, not only have I broken the 50-period simple moving average, I've broken the wave, I've broken 3,300, I've broken 3,200. So there's a number of very key price levels that we've been watching that have been broken. So I marry this kind of newfound pessimism fundamentally in the euro. Do a Google search, headline surf Google, type in euro, see what kind of headlines you get. They're very different than the kind of headlines we got even just 2 weeks ago. Technically, we've broken down. A key moving average, the 50-period simple, has been broken. For me, from a price action standpoint, 3,300 was a line in the sand. Broke that, it created a lot of resistance. In fact, 3,400 failure, in many ways, arguably started the sell-off. The fact that we couldn't find any love for this pair north of 3,400 probably was the catalyst for the bears feeling quite strong about driving this market lower, running stops, and taking them out at 3,300. So marry the fundamentals, the technicals, and the price action and get a pretty good idea that, hey, I can't be as predictably, reliably bullish about the euro as I was even just a couple weeks ago. No way. In fact, when I started plotting these blue candles, the blue grab candles that you see on the chart here, when I started plotting these, we were actually getting a little bit more neutral on the euro-US, actually more neutral on the euro period. So I'm having a hard time seeing follow-through on the euro-US, which I'm no longer looking for upside follow-through on. But it also makes me wonder about even things like the euro's relationship to an obviously very weak yen. This yen hasn't put in a lower low on the Japanese yen futures. We haven't put in a higher high on the dollar, on the euro yen. We haven't put in a higher high. Let's see. There we go. Even on the dollar yen. Even with all the dollar bullishness we had yesterday with the Fed, we still haven't even, the aftermath of the Fed is what I should say. We haven't even put in a higher high here. The yen has been rather inexplicably strong. There was some conversation that Japanese exporters got into the market, started buying yen, and that ran stops to the upside. I do think the yen weakness is going to resume because I don't think that Abe and the BOJ are going to shift away from weakening the yen. I think they have no intention of doing that. They had some political posturing in front of the G20 to say, oh, we didn't think the yen was going to depreciate that quickly. Wink, wink. Who believes that for even 1 second? But they had to do this kind of political posturing in front of G20 because everybody knew they were going to be the whipping boy that weekend. Okay? Ultimately, the G20 came and went with zero impact, which is pretty much what a lot of us thought was going to happen. But the volatility we had to withstand going into it, that's fundamental, right? We knew the calendar had the G20. We saw the headlines coming out. That was stuff you can expect. But that has, in effect, that volatility did slow down that terrific organization of higher highs in the dollar yen, higher highs in the euro yen. Okay? And you can even see here, Kiwi yen. Okay? So there is a big question mark lingering over how much more weakness we're going to get out of the yen, say, in the near term. I think longer term, if you can stand through some of this perhaps near-term chop, I think we do expect higher highs out of all these pairs, which is to say we expect more Japanese yen weakness. I want you to notice one thing in common with the Kiwi yen and the euro yen and the dollar yen. They all have bullish directional bias. I feel very confident about the fact that pullback support will be bought into. I don't have that opinion on the pound yen. And what's happened with the pound yen? Here I have actually two competing weak currencies. I have two competing weak currencies. The individual stories, this kind of goes back to Mike's question. The individual currencies don't have a great story when it comes to putting them together for this pair. In other words, I like the dollar yen because if the Fed is going to end QE, that's a dollar bullish story. I think ultimately the optimism about Europe is going to cycle back around. We're kind of in the merry-go-round right now. The pessimism part of the merry-go-round is spinning by. Okay, I do think ultimately the euro is going to start outpacing the yen again and move higher. I think the same thing with the Kiwi. Once this post-Wheeler environment just kind of fades away and people come back to their senses and realize the RBNZ is not going to act and they discount any kind of concern that they might, I think the Kiwi is going to start beating up on the yen as well. I don't suspect that the pound will. In fact, again, imagine these two are fighters. You got the pound on one corner of the ring, you got the yen on the other, and they come to the middle of the ring and it's time to start fighting, start throwing punches. I don't know that the pound is really going to beat the yen up. Not convincingly. Not the way I think the dollar, US dollar, not the way I think the euro or even the New Zealand dollar could. Heck, even the Australian dollar. I'm not committing to the Australian dollar because I think ultimately the central bank there is going to be driving a dovish story through that pair, and ultimately it will weaken. I see weaker Aussie going into the next few months. Now, we're not seeing it yet. The Aussie continues to shrug off any negativity because ultimately it's the safe haven currency right now. That's where Australia, New Zealand, they're getting those inflows. So that's more than enough, it seems right now, to shrug off any kind of negative story. Okay, but I believe the RBA has to act. The currency is darn near too strong for exporters in Australia to deal with. Coal exports are suffering. Even yellowtail wine is, how many of you have seen yellowtail wine on the shelves? You don't think Forex affects our everyday lives? Yellowtail wine, it's in most retail grocery stores. They're suffering. They're an Australian company. They're suffering because of the strong Australian dollar. Blueberries. Who knew blueberries were a huge export for Australia? Suffering because of the strong Aussie. So the RBA has got to act at some point. And again, if you were to ask most traders late last year, nobody expected a January or February rate cut out of the RBA. All the discounting went into March. And after March, a lot of traders were expecting another 0.75 of a point throughout the rest of the year. None of that's being discounted right now, but it is this very quiet, slightly unrespected story. When will I know that's being discounted? When I see the Aussie start to weaken. Okay? So again, do I have directional bias in the pound yen? I do not. I do not have directional bias there. So is this a pair that I'm very interested in trading? Is the trend my friend here? Is the trend my friend here? No, I have no trend. I'm friendless. I'm friendless here. Okay, so if I want to take advantage of any kind of yen weakness, why would I force the issue with the yen versus the pound when I have much better stories with the Swissy versus the yen, the euro versus the yen, dollar versus the yen, the Kiwi versus the yen? Heck, even, take a look here, even the loonie versus the yen. Not a pair that I'm really anxious to hop into, but I probably could expect more loonie strength versus the yen than I could expect pound strength versus the yen. The loonie would not be one of my favorites, but Swissy, euro, Kiwi, dollar, those are all relationships where we can feel that that base currency versus the yen as a second currency has a better chance of outpacing the yen and moving those pairs up higher. Now, if I get renewed yen weakness, all the better, because those pairs will be firing on both cylinders. And that's ultimately what we want. We want a pair to be working for us individually. Each currency is doing its job to move the pair higher or lower. That's when we get the great volatility that we've seen for the past 6 weeks, but that actually right now is starting to look really shaky. So I find it kind of funny that of all the weeks that I'm going to talk about directional bias, I'm talking about one where those biases have been shaken probably the most significantly they have been for the year. Kiwi, the resolve behind the Kiwi bullishness, the resolve behind the Euro bullishness. Dollar is all of a sudden a strong, the U.S. dollar is all of a sudden a strong currency, although I think ultimately it's going to put in a daily double top and exhaust. But that right now is a strong currency. Yen weakness story, which was the gift that kept on giving since last October, isn't feeling as generous. Okay? Kiwi, strength, not following through. Okay? So we do have some shake-up. Do I think ultimately those trends will continue? I think if you pit a strong currency versus a weak one, you're in a better situation. I don't want to pit a weak currency against a weak currency, which is what we would be doing with, say, something like the pound yen. Okay? All right, so that is our talk for today. That is our discussion of directional bias. I hope it started a discussion here. I don't necessarily feel I'm going to answer all your questions about the market in a single 1 hour talk, right? But I think we can elevate the debate. We can bring the discussion forward and build on it. Of course, you can follow me over at the Daily Forex Trading Edge, where I write every day and have commentary there, and we can keep the conversation going here once a month.